Good morning, traders. It's James Thorpe stepping in for Steve Miley on Tuesday, the 12th of July. And as Steve likes to say, welcome, welcome, welcome. Good morning to our US traders. Good afternoon to our European traders. And good evening to our Asian traders. Just put my phone on silent so I don't get distracted. So, how is everybody? We are in for a very quiet trading session, I think, today. Obviously, barring any breaking news or any earnings that are way out of line, but there aren't really any sort of big major companies that are reporting today. But I'll come on to that in a moment. I just want to start the meeting by having a look at a couple of things that caught my eye this week that I just wanted to share with you. Sort of setting a bit of a scene. The first is published by Bloomberg yesterday. I don't know if Steve actually covered it in the meeting. I missed Steve's meeting, but there's been a notable willingness to re-embrace risk assets so far this month, but still signs of traders willing to bet against them. Net short non-commercial S&P 500 futures positions increased for a third straight week and have hit their largest since June 2020, according to the latest data from the Commodities Futures Trading Commission. So the various bets have been grown despite or possibly because of the US stock benchmark climbing over 6%. So are they selling into rallies? That's what it's saying here. Obviously, recession fear has been well documented, as has the likelihood that earnings estimates are too high, right? We're moving into earnings season at the moment. Companies have started to report their earnings, and the fear is that some of those estimates are too high and the actual earnings will disappoint the market. So the reason why I just wanted to show you this chart because let me see if I can expand it so you can see it better. Zoom in on it. There we go. Right. Okay. So first of all, net commercial, less commercial. What was the word they used? Net short, non-commercial. So non-commercial would be hedgers hedging their position. So what they're saying here, these are more speculative positions, right? So people betting on the direction of the S&P, and you can see here as we've grown, as the market's gone up in the last few days, last week or so, also I don't know when that low was actually, sort of early, sort of later June. We'll have a look at that on the charts in a minute. The actual people have been selling into it and taking short positions, expecting it to sell. Now, I wouldn't read too much into that. In fact, if we actually look through the history of net short versus net longs, this is net shorts here increasing, and they got it wrong. Decreasing. This is longs and actually came off during this period, but they got it eventually. The market went up and the shorts built up, but the market went up. You can see, sometimes they get it right, sometimes they get it wrong. It doesn't mean too much. But why I wanted to point it out to you is that we have a situation here. Oh, good morning, George. Howdy to you. Tip of the hat to you, young man. Sorry about that. Some of George's writing in the chat. So if you're in the chat and you want to ask us any questions or just want to say hi, please do. Looking at this chart here, sorry, George, you made me lose my thread. Right, so don't read too much into it. But why am I showing you this? Well, if the net short positions are building up, we have the CPI number tomorrow, right? Now, we know now that the CPI is the most important figure of the month. I would say that, it's the most important figure globally of the month, not just in the United States. All eyes on the United States CPI. And if we get a softer print tomorrow, the expectation is that it's going to come in a little bit firmer. But if we get a significantly softer print tomorrow, right, of course we're going to rally in stocks. We know that. But how hard is that rally going to be? These people here, I think, are positioning themselves for further sort of downward leg in the stock market. And fundamentally, if we start to see a softening inflation, they know they're wrong and they're going to have to cover those shorts. So it will be, not only will we see a rally, but that's going to set the tone and the momentum over the days, maybe even weeks coming. And what all these shorts here are going to have to do is cover them, assuming that they're in it for, let's say, they're in it for the short to medium term outlook. I mean, the long term outlook, could remain bearish. Okay, maybe inflation's dropping off, but is growth slowing down? Let's have a look at earnings. Blah 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 blah. The point is this, we know which way the market is positioned now, right? And if the market starts moving against that positioning, some, at least, of those traders are going to have to cover that position, and that's going to cause it to go, significantly higher. And we'll see how it all plays out. Anyway, I just wanted to highlight that to you. And then the other thing is, as well, we have the first reading of the second quarter of the US GDP coming out this month. Now, why is that important? Obviously, GDP, gross domestic product. If it prints a negative number in 2 quarters in a row, that's defined as a recession. The growth is important, but what's important to understand is, which GDP is reported every month, and which months are the most important readings. And it's this month's reading as opposed to next month and the month after. So there's 3 readings in GDP. I'm not going to go into it in too much detail here because I don't want to waste your time this morning. Some of you will know this, but if you don't know this, head over to our free courses section, head into the fundamental analysis course, and look for lesson 6 fundamental analysis and this is called key economic indicators of the financials. Right, I cover the GDP number and how it's released. So what happens is this month is we look at, it's the first estimate, it's the first reading of the second quarter of the year, and then next month will be the second reading when we have more data in and it becomes more accurate, and the third month will be the third, which will be the final reading, which will be when we have much more data in about that second quarter. So the reading tends to get more accurate, and the resulting market movements become more stable as the months go on until we get the first reading of the third quarter, which is 3 months away, right? So this month is the first reading of the second quarter. It's important to know that. That's later on in the month. We'll be watching that very, very closely. But looking at the key economic indicators, have I got I don't even think I have let's go back to the trading room and let's get on the data release calendar. Looking at the data release calendar, we have a very light day today. I'll just go over it very quickly, but tomorrow, got some French CPI, got some German CPI, some UK GDP numbers tomorrow. And here we are, the US CPI looming large over us. The most important number of the month. This is tomorrow, the most important month of the month, the whole world watching it. And likely to mean we have a very quiet session today. All right, ahead of this, everybody's waiting to see what this does. Is it the most important number to date? Maybe. I mean, really, if you think about what's happening in the supply chains, what we're starting to see now, particularly, is a little bit of sort of like loosening up of those supply chains, and commodities have come off quite significantly, especially metals. So the feeling is, and energy prices. Now, I think it's going to take another month or so for that to cycle through to the number. So I'm thinking tomorrow's number is going to hit around here anyway, maybe a little bit hotter. But people are all focus on the CPI tomorrow, which means we're going to see very little action today, especially given. Can I go back to today's calendar? The light calendar this morning. We have had Germany ZEW out, which was a big number that we used to trade in London when we were trading European interest rates and European bond markets. My wife was a Bund trader, which is a government German 10-year bond, which is the really the benchmark for all European bonds. And it's the most liquid, and it trades on Eurex. And we used to watch ZEW or ZOO really closely, and it's had a huge misprint this morning. Right, so the forecast was minus 38, is minus 53. So no doubt that's impacted European stocks. We'll take a look in a moment. But apart from that, we really don't have much on the books. If you're trading indices, equity indexes, which most of you are, we have some commodity reports, the WASDA, but no one's trading commodities with us at the moment. So, we tend to focus a lot on the bond markets and the equity markets because, they're very closely correlated. Most of our traders are trading equities. Today, Thomas Barkin, who is a member of the Fed, here we are, this guy here speaks at 12:30. He's talking. He's at a lunch. Good for him. Very nice at the Rotary Club, and he'll be asked, no doubt, about or make comment on inflation. So we'll see what he has to say. And then also the Bank of England governor Andrew Bailey is speaking, although he's going to be focusing more on COVID-19 and the impact or influence it's had on more long-term structural forces that's going to really affect the landscape of policy making for years to come. So, how has COVID-19 changed everything? Now, no doubt, he can't really talk without mentioning inflation at the moment and the impact that COVID-19 has had on it. So, we will be listening closely to what Andrew Bailey has to say, and the FOMC member Barkin. Largely because there's not much else out today. We do have some earnings reports. Let me have a look here. Yeah, so the earnings season. So I'm on this calendar, markets.businessinsider.com, and you can see all the companies reporting today. But as you go through, PepsiCo is the largest, I think. There's really, we will be looking at the general, general sentiment that comes out from these reports, but we won't be, particularly looking at any specific company. So, particularly if you're trading Nasdaq, what you're more interested in is the FANG reports, right? Facebook, Amazon, Google, Netflix, and some of the big bank reports if you're trading the S&Ps. But tends to be a handful of smaller companies today. But we'll be watching what the general sentiment is. Are there a lot of misses? If there are a lot of misses, that's going to put some softness in the market today. But generally speaking, ahead of tomorrow, it's going to be really, really quiet. Let's close that out. Right, covered that. Covered the market reports. Let's have a look at some of the headlines. Germany economic sentiment, I just talked about this. It misses 53.8 versus 38.3. It actually doesn't really have any rationale or reason. Combination of concerns about energy supply in Germany, the ECB's planned rate hikes, and further pandemic-related restrictions in China have led to a considerable deterioration in the economic outlook. Well, hardly a surprise, is it? What I'm going to do actually is go back and just open up the German ZEW and see if there is a definition. The German Zentrum für pass. ZEW Economic Sentiment Index gauges the 6-month economic outlook, right? A level above zero indicates optimism, below indicates pessimism. The reading is compiled from a survey about 350 German institutional investors and analysts. So it's an outlook report. That's a survey, based from German institutional investors and analysts. So that's why big sort of asset managers, maybe some hedge funds thrown in there, and bank analysts on the outlook for Germany. And a zero is a neutral reading. We are down minus 53. So they are not very optimistic about the future in Germany. All right, let's close out that. We looked at ZEW. Let's close out that. What else we have? This is the Reuters page that we go to check the news, and you can see here like they're leading with Mercedes-Benz starts trial in class action suit. I mean, that just gives you an indication of the lack of real market moving news that came out overnight too. So, again, nothing to really impact us in the US. Again, maybe a bit of softness out of Europe is going to impact our open. The Euro stocks are down 0.57. It's not a great deal. Maybe a bit of softness out of Europe is going to impact us. Earnings reports, and we've got the couple of central bankers speaking, but really the focus is tomorrow. We're going to be in for a quiet session, traders. Please be careful. Please don't get chopped up. Please don't get topped and tailed. There's a couple of things from here I wanted to point out. This is a narrative that's starting to appear across some analysts and some corners of the market. People are talking about rate cuts. Can you believe that? I think what the feeling is that the central banks will need to be somewhat aggressive in their rate hikes to try and combat inflation. And they're pricing those in, 3/4 point, whatever it might be. But where is the terminal rate? Where does it end? And then what happens after that? And the narrative is starting to creep in that they're going to come down pretty fast. They're going to go up pretty fast, cap inflation, and come down pretty fast. And it makes sense as a narrative. I think it's a little over optimistic, but you're talking to James Thorpe, the perpetual bear. I'm always a little bit more pessimistic, but it kind of I can see a scenario where they raise rates and they stop inflation, but I can see inflation being a little stubborn and sticking around for a while. So it'll be difficult for them to cut rates in that environment. But I think the narrative is, once they've got inflation under control through aggressive rate hikes, then the focus will shift very quickly from inflation to trying to avoid a recession or a soft landing and cut quite quickly. So here, like Nomura says, that it expects the Fed to reach a terminal rate at 3.5 to 3.75 by February 2023. Terminal rate, as I've said, is like the highest that they think the interest rates will go. And I think that they're going to keep hiking rates until around February 2023, and then before proceeding to start to cut rates in September 2023. So they're thinking there, sort of 7 or 8 months of holding rates, trying to, see if inflation starts to soften and see if that starts to develop a trend of continuing softening, and that will open the door to further to start the rate cuts. And they mentioned, meanwhile, their firm expects the ECB to hike rates by 175 basis points come March next year, before starting out with small quarter point cuts, or 25 basis points in June 2023. So, it seems like the US are going higher, staying higher longer, and coming off. And then it seems like Europe is going up as well, but staying higher for a short period before coming off. That's Nomura. They also chip in with a Bank of England forecast expecting 2 rate cuts in May and August next year, after having 100 basis points worth of rate hikes this year. I never put any stock in one analyst's or one institution's reports. But I just wanted to highlight it to you because it is a narrative I'm starting to see out of a few institutions that, the terminal rate's going to hit around here. And then, we should see rate cuts quite quickly after it. I guess we'll have to wait and see. Good morning, Clinton. Hat tip to you. Thanks for joining the meeting. And then we are over to This. Okay, so here's quite a big story that's been going on. I'm sure Steve's been highlighting it to you. Euro USD hits parity for the first time since 2002, right? It's been heading this way. It's like a magnet when when it was getting in sort of getting close. And the reason why I want to highlight it to you is not necessarily anything to do with the euro. Um, when I was reading this story, one thing that stuck in my mind that I thought I want to bring to the attention of my traders. And it's like, I'll just read it to you. All eyes are on the Euro USD chart at the moment as the pair flirts with potential break of parity. All things being equal, that's a major psychological level. Right. A major psychological level. What's a psychological level? Now, some of you who've been around markets a while will know this, but some of you who are new, traders often cite what we call round numbers or big figures as potential areas of support and resistance. So it's not necessarily a technical level. It's not a level where the market had paused and retraced or bounced and rallied before, like a classic level of support and resistance. It's more a psychological level based on the actual number that it's trading at. What do I mean? Let's have a go to the admin. Let's go to the charts and have a look here. Here's gold, right? Here's a gold chart at the moment. You see here the price of gold at 1700. There's actually there's a little bit of support above it, but there's no support at 1700. Yet people will see 1700 as a psychological level of support. And the same up here, see like the price of gold, $2,000 a troy ounce. It's a psychological level of resistance. Same at 1900, right? No level of resistance, clear level of resistance here, but people will see this as a psychological level of resistance. And what does that mean? Well, it means that there might be some stops sitting the other side of it, or it might mean it might meet some resistance, right? As it gets there, people are like, well, I don't think it's worth above $1,900 a troy ounce, so I'm going to start selling it. So that's what a psychological level is. It's usually a significant level. Like in the bond market, it might be around yields, but in when we're trading equity indexes and oil, it's always around price and what that price is. Oil could be $100 a barrel or $110 a barrel, but it's usually around these sort of like big numbers, these even numbers. Gold will have a psychological level here, as I said, at 1700, the same at 1600, same at 1500, and you do see price action alter. Now, I'm going to share something with you here. Um, just prior to me starting trade day, so I just left a proprietary trading group, managing a proprietary trading group in Chicago, and an acquaintance of mine owns a software company in Europe. And that software company sells what we call best execution into banks. Now, best execution software, what that does is it helps banks execute large orders in the market by disguising them. All right. So if you've got an order to buy, let's say, 5,000 S&Ps or 3,000 or 2,000 S&Ps, if you got S&Ps, buy them at market, that's going to move the market. And not only that, if you attempt to buy them like in 500 or 100 lot clips, 100 by 100 by 100 by 100 by 100, that's what we call information leak. Right. And the market participants can read that there's a buyer in the market, and that price that they might start to try and front run that order and start to rally the market up. So what big banks and big institutions do is they use software called best execution software. Now, bear with me. I'll get to the point in a minute, right? But best execution software and smart order routing for products that are traded on multiple exchanges like equities, and transaction cost analysis. So that's like the package suite of software that is used by banks and big hedge funds and big asset managers. If they're doing their own execution, they're probably handing it off to the bank's desk. But it's best execution. What it does is it slices and dices that order up into sort of smaller parts to try and disguise that information leak. So if you think about it this way, as I said, you've got to buy 5,000 S&Ps. It might buy 50, it might buy 75, it might buy 100, it might, it buys it in like small clips. It might be passive, work the order, it might be aggressive, lift the offer. And the way it makes its decisions is through quantitative analysis of the market over look back periods and other market logic. And part of that execution, believe it or not, is psychological levels. And the reason why that's part of that execution is not because the guy that wrote the software thought, psychological level, is because through quantitative analysis, they realize that the market will more likely hold or hold resistance or hold support at a round number than it will at any other number. Now, it's not much, not by much. It's like it increases the probability just by a few points but you need to know that when you're creating these smart algorithms that are doing this best execution. So the reason why I'm telling you all this is to give you empirical evidence that round numbers like here we are in gold again, like $1,900 or $2,000 or $1,700 in gold, aren't just psychological, or they are psychological levels, but people are acting on them. Not only are people thinking, oh, I don't want to, I want to buy it above 1,700 or I want to sell it below 1,900. So there's natural buying and selling in there, but we can quantify that. It's been quantified through mathematics. Now, it doesn't mean when it gets there, of course, it's always going to hold or you're going to meet huge amounts of resistance. All I'm saying is, you're much more likely to find buying at 1,700 than you are like at 1,701 or 1,702 or 1,703. And you're much more likely to find selling here in the gold at 2,000 than you are at 1,950 or 1,980 or 1,995. Right? It's really important that you know about these levels. So I just wanted to share that anecdote with you and give you a heads up. Archie, throw in a question. Are we talking about dark pools? It's a good question, Archie. I think what you're referring to is like the smart order routing, a part of the best execution. So what happens typically in equities is they trade on a number of venues, right? And the United States is the most fragmented equity market globally. And the big stocks can trade on up to something like 50 venues in the United States, 50 exchanges. Now, some of those exchanges are what we call lit or light pools. And what that means is that they're transparent and accessible to everybody. So like the New York Stock Exchange, the NASDAQ, there's quite a few of them. And then some of those exchanges or pools of liquidity are what we call dark pools. So they're not lit, they're dark. And what that means essentially is they're not open to the public. So there might be a pool of liquidity sitting within a bank. So the bank has all its customers and it's matching its orders internally for that. Or if you try and buy shares, they might route it to that dark pool if they have a customer on the other side, and thereby, one, being able to hide the information leak that's going on, and two, execute it in a more efficient manner. Now, what smart order routing does is it connects to all the lit venues and connects to a lot of the dark pool venues. So if you want to buy, a million shares of Apple, or a million shares of Apple, whatever it might be, just using that number, pulling that number out of my ass. But if you want to buy a million shares of Apple, what it does, it scans all the light and dark pools and finds out where the best price is. Now, they may be trading at the same price, but some venues will reward you with rebates. Some venues have cheaper commissions to execute on. Some venues will reward you for being aggressive and taking liquidity. Some venues will reward you for being passive and creating liquidity. And that's what the smart order router does. It looks where's the best place to execute this part of the order at this point in time. And then to layer on top of that, we have what's called transaction cost analysis, which then creates a nice report for the broker, so he can say, okay, I bought 10,000 Apple shares on this venue, 5,000 Apple shares on that venue, 700 Apple shares on that venue, and 15,000 on that venue, and it was order routed, and you can see why they were routed to those particular pools. It's fascinating, really. I was tasked with opening a US entity for that company in November 2019, and set up a sales office and hire some quants and some support guys, and we were going to try and get a footprint going for that company in the United States. They have quite a significant footprint in Europe and a small footprint in Asia, and they saw the US as their next territory, and they. And what happened was COVID rolled into town, and I was basically let go, and they pulled their investment, so they no longer have a US office, which at the time was a nightmare. But right now, today, I sit here talking to you as a result. Without that event in my life, there would be no trade day. So ultimately, I'm thankful that things worked out the way they did. And Archie, you're welcome for that explanation. I hope it made sense. I didn't mean to rabbit on too much. Um, where are we? Okay, we've talked about psychological lessons. Right, let's go back to let's go to the charts and wrap it up. Right, we're in for a quiet session. Please be careful, people. This is the S&P daily and hourly. We can see here we are bounced from these lows a few weeks ago. It's still from a daily chart point of view, looks firmly in a downtrend. I know Steve's been bullish for a few weeks and called it right, but we have had some severe corrections of this bull trend. Personally, I think we're going to be consolidating into this area for the rest of the day. This is the low so far on the day. You could argue that it's going to struggle to break this level here, which is the low from a few days ago last week. Which will coincide really with this kind of level of support here on this small trend. So I don't think it's going to go any lower than here today. And I don't think it's going to break yesterday's highs, because that will put it back up sort of towards, this kind of like where it's starting to meet a little bit of resistance in the downward trend. So I think we're in for here's the hourly chart. We have these levels of support through here. And here it's already sort of bounced off this level of support. I don't think it's going to get above these levels here. And if it does, it's going to sort of fade back into this sort of like range here. So it's a quiet day. It's very hard to sort of pick out any sort of technical opportunities for you. I know this is Steve's area of expertise, not mine, so I apologize. Looking at the Nasdaq, we've got sort of a double top going on here. Can you see it breaking here today? With that lack of any breaking news coming out, or any or any sort of like real surprises from any sort of Fed speakers. There's no really reason why it should break this ahead of the CPI tomorrow, right? And there's no real reason why it should sort of get down and break these lows. I think it's going to, if it's going to sell off, boom, it's going to stop here, and if it's going to rally, it's going to sort of stop here at these levels. It's going to be difficult to trade ahead of that, as I said, because it's going to be quiet and it's going to be a little choppy, a little range bound, and a little, like fading out, etc. Treasuries, we think we have one person trading treasuries at the moment. It's trending up nicely, and it bounced off this level of daily level of resistance nicely. If you wanted to take a small risk reward trade here, you could sell it, and have like a stop above this level of resistance. But I don't see, again, ahead of tomorrow, I don't see any big moves. It actually looks quite firm, so it's a difficult sell right here. If I was to sell it, it'd be a very tight stop. I'll probably avoid that trade. And then into oil, we've just had an oil report this morning, which has put some pressure on. I think the oil report came out while we were talking. Looks like it's put some pressure on it a little bit. Oil's a little different, I mean, I don't want to go out on a limb here. It's definitely looking soft, and it's looking like it could trade lower today. I think it will struggle to break this level here that it put in at around $95 a barrel. Particularly ahead of the number tomorrow. I wouldn't want to be long oil right now, would you? By the looks of it, but where's it trading? It's trading at. Let's get rid of the data box. $99, potential to go down to sort of 95. Yeah, it's got a good trade, but where's your stop? If you were to go short, where's your stop? What, above this bar? We could quite easily sort of consolidate here a little bit and come up and test a small retracement before coming off. So it's going to stop you out. Your stop has to be up here, sort of like 102, I would imagine. So, a stop of 102 to try and make 95. So where are we? 99. So $3 stop to try and make $4. It's not a very good risk reward opportunity, people. So, I'm not going to trade today. To be honest, I actually haven't been trading that much at all for a month and a half, just because I've been so busy with trade day. But if I was trading, full time, or trying to go through the challenge, I might actually not even trade at all today ahead of CPI. Gold, for you gold bugs, what a difficult market to trade. Breaks this level of support, fades you out, triggers your stop, goes back up into the range, breaks this level of resistance, it gets you long, fails, comes back, stops you out, puts you back in the range, comes out the range, back in. It's like, it seems to me to be a very difficult market to trade at the moment, gold. I mean, I wouldn't want to be long if I was long term, but it doesn't seem to be like a lot of opportunity there. Look, it's 7:07. I'm going to wrap it up. George, Clinton, Archie, thanks for joining me in the chat this morning in the meeting. Take it easy, guys. Really, ahead of these big numbers, the markets do go quiet. I know there is a pressure on you or that you feel like there's a pressure on you to trade every day because you're day traders. Try and fight that pressure. You're looking for opportunity, and there's not always opportunity in the market. One more thing, I like to wrap it up with a daily thought. I forgot that I actually printed this off. So I was having an email conversation with one of our traders yesterday, and I just wanted to. I'm probably not going to spend too much time on this because I want to write a long form piece on it, publish it, so we can always go back and reference it. But one of the things that you want to be focusing on in your trading is not the cash, not how much money you're making or losing, right? Focus on the ticks, your metrics. I'm going to read this, right? You need to stop thinking in terms of dollars and start measuring your success in ticks made. If a good trading day in the mini S&P is $500, that's about 40 ticks, right? A better day's trading is making 50 ticks in the micros. But that's only $40, right? So most people are like, but that's only $40. I made 500. No, this trader's managed to take out more ticks in the market than this trader. Right? Cash is a byproduct of good trading. It should never be your focus. If it is, you will never be able to recover from big trading losses, and you'll be constantly trying to chase dollars to dig yourself out of a hole, and things get worse when that happens. Now, I'll explain more on that in the long form article, but essentially what you should do when you suffer a big loss is you should reduce your trading size. Right? You need to reduce your trading size, get a few consistent days under your belt, get your trading confidence back, and then you can go back to trading what you were trading before. But it's a very hard thing to do because a lot of people are like, oh, wow, I lost $1,000 trading 2 lots in the NASDAQ, and now you're asking me to trade 2 micros. I'm never going to make that $1,000 back. No, it's not about making the $1,000 back. It's about getting your consistency back, and it's easier to do trading 2-lot micros. And what's more, if you continue to lose money, it won't cost you anything because you're only trading 2-lot micros. Trade 2-lot micros, get your consistency back, then you can go back to trading minis. All right, but you can't do that if you're focusing on the dollars. Always focus on the ticks, track your metrics, review your trading, and record your best days and worst days in ticks. These are your benchmarks, and that's what you should be focusing on, not the cash. You know, for me, a trader who makes 100 ticks in a day is better than trading micros. It's better than a trader who makes 50 ticks in a day trading minis. You know, regardless of the tick size, that trader's managed to pull more ticks out of the market, and that's what your focus should be. I'm going to leave it there as the thought for today. I hope that's useful. I wish you all a great trading day. Take it easy, traders. There's not much going to happen ahead of CPI, barring any breaking news. Good luck.